Ray Dalio is one of the world's most respected investors. He runs Bridgewater, the largest private hedge fund in the world, and he has a personal net worth of over $20 billion. And although his investing style and targeted returns doesn't exactly mirror what I'm looking for, he's an expert in achieving what he calls the Holy Grail. And this is a term, obviously, he coined himself, but it means investing and building your portfolio in a way that provides the best risk-adjusted returns. Essentially, an all-weather portfolio which guarantees moderate to high returns with relatively low or no risk. And that's why I thought his thoughts and advice on investing in China are so interesting. His hedge funds own large stakes in various Chinese companies and ETFs, the largest one being in Alibaba. But drawing on his vast experience and knowledge of China, he sheds a positive light on China's capital markets and dismisses, some of the recent fear in markets as a misunderstanding or misinterpretation of the long-term trends. This is coming from someone whose first focus is to protect his downside or protect his investors' downside, and is a proven expert in it. So when you think about, people's current views on China, especially names like Alibaba and Tencent, etc., nobody argues with the big growth potential and tailwinds that are there. They just associate too much risk with the names and with China. So it's compelling to see someone of Ray Dalio's ilk saying the risk is misunderstood and that he is bullish. So in this video, I'm going to be covering some of the highlights of his most recent article and discuss my thoughts on all of the points that he raised. And this article was called Understanding China's Recent Moves in its Capital Markets. He posted it on LinkedIn just after the collective list of crackdown news, and he references the Didi listing scandal and the education companies as the primary catalyst for doubt about China's capital markets. But his plan here is to help clarify what is going on. So he starts with letting us know that he has been going to China for 36 years now. So he's very familiar with the culture, the ambitions, and the intentions of policymakers. And I'd assume he's actually been in close contact with China's policymakers quite frequently in the past, which is probably why he is referencing it. Now, as an overarch to help us understand what's going on, we really need to understand that China is a state-run capitalist system, so different to what we know in the West. And it means that the state runs capitalism to serve the interests of their people. And policymakers won't let the sensitivities of capital markets, like we see in the US and Europe, and billionaires stand in the way of doing what they believe is best for their country. And a good example here is, it's okay to have riches and make lots of money for yourself or your investors, but don't mistake those riches for having the power to determine exactly how things will go in the future. That will be the job of policymakers and the government. And he goes on to say, I have found most Western observers who do not have direct contact with policymakers and don't follow the patterns of change do not believe that the Chinese Communist Party's usage of capital markets to foster or create economic development is real. They interpret moves like these two recent ones as the Communist Party showing their true anti-capitalist stripes, even though the trend over the last 40 years has clearly been so strong towards developing a market economy with capital markets and entrepreneurs and capitalists becoming rich. And as a result, they've missed out on what's going on in China and probably will continue to miss out. And I love this. It's true if you were bullish on China over the past decade, you would have done extremely well as an investor. And, the story is far from over. China still has a very long way to go before fulfilling its full potential. But people like to believe that China only wants to destroy its companies if they succeed, rather than actually looking at the long-term trends that they've laid out. And in next to no time, China has risen the majority of its population out of poverty and become the second largest global economic superpower, a lot of which was due to its adoption of a state-run capitalist system, and more importantly, capital markets, which allowed for major foreign investment. And Ray Dalio isn't the only man of wisdom who shares this exact view. Charlie Munger, a true patriot of America, 97 years of age, one of the best investors and most intelligent individuals that I know of, had similar things to say about China's progress and true capitalist intentions.
China's economic record among the big nations is the best that ever existed in the history of the world. And that's very interesting. A lot of people assume that since England led the Industrial Revolution and had free speech early, that free speech is required to have a booming economy as prescribed by Adam Smith. But the Chinese have proved you don't need free speech to have a wonderful economy. They just copied Adam Smith and left out the free speech, and it worked fine for them. As a matter of fact, it's not clear to me that China would have done better if they'd copied every aspect of English civilization. I think they would have come out worse. Entirely possible that our system is right for us and their system is right for them.
So not only Ray Dalio, Charlie Munger is echoing the same sort of message about China's strategy. But now back to the article. Ray Dalio importantly points out exactly why authorities decided to take such actions recently. And with Didi, they told them it would be best not to go ahead with their listing prior to dealing with their data privacy issues. And Didi obviously ignored that. We've been over that in a previous video. And then in the case of the educational companies, they wanted to reduce the severe educational inequality that exists in their country. It is bad in China. It's something they're trying to deal with, and they're trying to reduce the financial burden on those who are desperate to get education for their children but can't afford them. And they'll be doing this now by making education services widely available. And this is all important in context, both of these things, because it shows the actions were taken with a clear aim to protect their people's best interest and improve their country over the long term. It most definitely wasn't done as a power play or to punish their success. Now, he also mentioned some cases in the past in China that provided a similar short-term reaction in markets and even scared people off, for good, to the point where they missed the run-up in the economy over the past 5 to 6 years. And that's nothing out of the ordinary. We know markets overreact and have, very short-term memories. It's up to us to capitalize on that. But what I want to highlight here is how he says some skeptical investors looked at these moves as inappropriate and as anti-free market interventions, even though these same moves have happened, or very similar moves have happened many times in many capitalist markets. For example, handing out of large fines in the US and in Europe for some of the big tech companies, and mainly, which he references, is the major fiscal and monetary policy interventions in the US and Europe very recently that dwarfs the actions of the Chinese policymakers in recent years. And this is something, we spoke about in a couple of other videos that we've done on this channel. A lot of what people say puts them off investing in China and reference, all of these bad things the Chinese policymakers have done is happening right under their nose in the developed Western markets. But even with all of this in mind, he does remind us that there is, of course, risks to consider with investing in China. This isn't, a risk-free situation by any means. An example he uses is the geopolitical environment changing, and there are some increased geopolitical risks involved, which you can see in the US and the government's decision to, one, change its policies for Chinese companies listing in the US. They're enforcing stricter rules around, what they need to do to be listed on the US exchanges. And then lastly, or secondly, the threats to prohibit American pension funds from investing in China, which, for me, I hadn't actually heard much about the threats to prohibit pension funds, but it would be interesting to dive deeper into what sort of effect this would have on the Chinese stocks. But in my opinion, it would be in the US pension funds' best interest to keep the door open to China, especially to the more larger and established companies or ETFs, and with a clean track record, those companies really, I think, are less risky in that regard. But just given the opportunity there, I think it would be in their own best interest to not enforce that sort of rule. And Dalio's closing remarks, which I think are important and shows obviously everything about Ray Dalio, is to assume that such risks or such things could and will happen in the future and just invest accordingly. So if that's his take on it, then one would assume that he's not actually too worried about either of the two above situations or scenarios, both the pension fund scenario and some of the delisting scares becoming a reality, as he owns large stakes in Chinese stocks, like I said earlier, still owns them. Wouldn't be surprised if he was probably buying more this quarter or last. And he does also admit, it is a little bit unfortunate that China's policymakers don't publicly communicate the reasonings behind their moves more clearly. But I think by the looks of things and of recent news, this is definitely something that China are acutely aware of and they are working on to improve. And then just again, he reminds us one more time not to misinterpret these sort of moves as reversals of the trends that have been laid out and that have existed for decades, and allow it to scare us away from investing in China. That was probably the worst thing that we could do. And overall, a very insightful and much needed article from someone who's very familiar with the Chinese markets and managing risks. And in summary, if we just go to my key takeaways here from reading that, I'd say first of all, China's long-term trends are still very much intact. There is still a big opportunity there, even with the largest companies. And secondly, a lot of the recent news out of China, like I had already thought, and like some of you must have thought as well, it's been misinterpreted and its aims pretty much misunderstood by investors. I've got to say the media probably plays a bit of a role here too. This is what feeds us all of the information, and they can't help but spin it in a bad way. That's essentially what they get money to do. And there are definitely risks that exist in Chinese stocks, separate to investing in the US and Europe, but they are not catastrophic, and you need to assume such risks could and will happen at some point and just invest accordingly. And then lastly, I'd say that time has shown that periods of peak pessimism and uncertainty have in fact been the best times to invest, given that you have a medium to long-term investment horizon. So therefore, I'd go as far to say that China is a good buying opportunity right now, and Ray Dalio and a lot of other people think so, whether that be through a diversified ETF or choosing the right quality company to purchase stock in. They are, very much discounted relative to the rest of the markets, and on average have better future growth prospects. So thank you all for watching this video, guys. Hope you enjoyed the update. Hope you enjoyed the article from Ray Dalio and the summary. Just lastly, if you want to support the channel and get access to a number of benefits, including but not limited to all of my valuation models, some Patreon-only analysis and valuations every month, and as well as my portfolio, buys and sells, and a watch list of stocks covered with the target prices. You also get access to the investing Discord community. So if you're interested in that and joining the Patreon, I will leave a link in the description below. But apart from that, let me know, your thoughts on the topics covered today in the comments below. Leave a like if you enjoyed the video. Subscribe to the channel, obviously, if you're new around here or haven't already. I will see you all in the next one. Good luck with all of your investments.